Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boisseau. Today, I have Tracy King here, COO with the Partners Credit. Hi, Tracy. Thank you so much
Hi,
for being here.
thank
Thank
you.
you. Because again, you might notice, no Kevin. Second week in a row. So hopefully you guys can stand it. Tracy will balance me out. Thank God
I'll
for
do my
that.
best.
Thank God for that. All right. Well, we'll start with the usual, which is what's going on in the market? Let's just go with one word, volatile. So last week we were at the 10-year was at 4.65. I just stopped looking after a while. It was so ugh. And today we're at 4.5. So cross your fingers, say a prayer. It is at the moment head in the right direction, but you know how this goes lately. It could go any direction at any moment. You never freaking know. All right, so tomorrow we have mortgage applications. I was looking at the what was coming up next on the economic news for the week, and I was like, "Oh, mortgage apps, that's it." Oh, Thursday. Holy crap. Okay, so Thursday, we have PCE, the Fed's favorite measure of inflation, GDP, jobless claims, durable goods, and new home sales. So buckle up, kiddies. It's going to be a wild ride, or it could be, or maybe it won't be. Wouldn't that be nice? Wouldn't that be nice if we just sort of went through all of that and the market didn't even blink? That'd be amazing. So, Kevin Warsh was sworn in as our new Fed chair. It will be very interesting to see what happens next. The Fed minutes came out last week. They were 3 weeks old. A lot of people at that meeting, a number of people, really supported either raising the rates or removing the easing bias language from the Fed statement, neither of which happened last meeting. But now we do have a new Fed chair, so could happen. And Kevin Warsh has said that he will raise rates if that is what is necessary. And by the way, he's not the only person on that board. So the entire board will have to vote to do that. But the other thing too is don't forget our national debt. That is a huge issue that gets sort of forgotten in this conversation about the war and oil prices and inflation and what that's doing to everything. But we have this monstrous national debt that is, it just keeps increasing. So that's an issue for sure. And NBA thinks we're going to have a hike in 2027. So I have a lot to look forward to. My point is if you see a rate you like or can't, or a rate you can live with, lock it in for God's sake. I have this purchase I locked a couple weeks ago. I cannot tell you how many times I just thank God that I wasn't crossing my fingers and praying to God it was going to get better and then it didn't. Yeah, so just lock those rates and get those things closed as fast as you can. In other news, home price appreciation for March came out. Case-Shiller and FHFA were both showing um, slight increases year over year, 1% year over year for Case-Shiller, 2% for FHFA. Remember, FHFA doesn't have any cash or jumbo buyers in those numbers. They're always a little different, but not much. But positive, we're positive. That's a good thing. Yay. Okay. It's really weird not having Kevin here. I just feel like I'm talking to myself.
You kind of are. This is where you shine, and I'm smiling and nodding and applauding you from here. But there's a lot of acronyms that I don't have to touch, and it makes me very grateful. Yeah.
God, bless you, my child. Oh God. Okay, starts and permits for April were up. Building permits were up 5.8%. But it's a lot of multifamily, not single family. That really doesn't do much for us. Cotality's rental index for March came out. We are up 1% for March, 1.3% year over year. Remember, this is just single family new rents, which is only 15% of the market. All right. So, what else we got? Um, we're going to talk about credit, Tracy. I swear to Buddha, we are.
Oh, that's fine. We can.
Um, do you know that in Rob Christmas' blog today, he said that a minority of Americans believe their children will be able to buy a home? A minority of Americans believe their kids will be able to buy a home. This is not good news. It means we need to get out there as an industry and individually. Well, it starts individually and change that narrative. I think that, not I think, I know the narrative in the media across the whole news cycle is really negative. Oh, it's not affordable. Oh, you're going to be discriminated against. Oh, you can't do this. It's just all this negativity. And the reality is, we have more programs than ever to help more borrowers than ever. I don't know. What do you think, Tracy?
I wish I could be as positive as you. But I would say, when I bought my first home, it was sub 200,000. It was a nice home. It had updates in it. I mean, it was small. It was my little shoebox, but it was a good, solid home. You can't find now that house that was my starter house. I think it was 180 maybe in the same, and now all those updates are 10 years older, 15 years older. It's close to 350. And when I first came into the industry, my salary, that was a very different bracket of what I thought I could afford. So I think it is very important to work with people, see what they need, look into those programs and educate for sure, because even, knowing what's out there, it does feel like it's impossible. But I think that's where you start getting creative and look outside, you know, different areas, look inside of what you think you need versus, what's out there and what's the bang for your buck where you can get it and then grow. I think there's
Okay.
more of that.
Okay, so here's a question. Could you afford to buy that same house today?
Yes,
Okay, so it's still affordable for you.
correct.
So if you had, well,
And
yeah,
I make a very different paycheck than I did 20 years ago. Yeah.
fair enough. Fair enough. The reason I ask is we had a second economist last week. We had Nadia Evangelou with NAR on, and she cited a study where and she's not the only one. Logan Montashami from Housing
Hmm.
Wire has also said the same thing, which is there are studies that show that affordability is better now than it was decades ago. And I find it interesting, depending on whose data you're looking at, that there's such a disconnect. And we often talk about the fact that, in California, like in my dreams, I can buy a house for $350,000. I mean,
Right,
and not live, 4 hours from my office.
right.
So it is so in California, the numbers are very, very different, as we know, yet the delinquency rates on mortgage payments are much lower, or some of the lower on the lower end of the numbers in the country. So how it, you know what I mean? Like there's
Yeah.
so there the data is the data. I mean, these economists, it's interesting. The more I have spoken to many of them over the years now, they sit in their offices and they digest data. They just love numbers. They don't really, they're not as interested in is it brand new data? They just like data.
Right.
Like
Yeah.
let me crunch some numbers. And as LOs, we're on the ground talking to borrowers and working with their numbers, et cetera. And I mean, people are able to buy houses. And if we're creative and have access to all these other programs, that really does help, actually. And yeah, I don't know. I just feel like if we keep telling everyone they can't, they won't even
I
try.
I agree. Well, and part of it, and what you say is a really good point too, because when you're looking at data and all of this, I'm a Midwestern girl. So there's a different mentality of what the house should be, like how much it costs, what your cost of living should be. Like I grew up with like, do not be house poor, do not be house poor. And you go to different places, New York, Arizona, now Texas, California for sure, that is the commitment you're making. I mean, I have friends who I know that I made the same amount of money and their house was twice the price of mine. And I was like, whoa, whoa, whoa. So I think you're very right in terms of like it is a state of mind as well and how you need to, we need to think about it differently. If the housing pricing is higher, how do we mold to it? How do we work with it? How do we adjust? And it is very much the mentality of who your borrower it is, what your borrower is and how you kind of connect to that and guide them through. And this is how it always comes down to me of whenever I've gone through something, even though I know the industry, the person that takes the time to talk me through it versus rattling off really, numbers really quick. Um, I want the person that's gonna talk me through it to help me understand. And it still shocks me when we're all looking for borrowers, how little time people have for those borrowers sometimes. Yeah.
Yeah, 100%. It is, I often hear from LOs who just want to email. They're like,
Mhm.
they just want to email with people. I'm like, well, if that's all a borrower is doing with you, they can just push a button and get, whatever, go chase the lowest rate instead of having somebody who is going to strategize with them and help them make a good decision for their personal, financial state.
Yeah.
There was an interesting post, Rich Schwerbinski,
Yeah.
who
Love
I
him.
know you know.
Yeah.
He is very prolific on LinkedIn. It's really interesting. Sometimes his, oh my God, sometimes his,
He has opinions,
oh,
and he's
and
not afraid to
no,
say
he is
them.
not. But
Yeah.
he's also smart and he's thoughtful. And
Yes.
whether or not you agree with him all the time is it, he's throwing ideas out there, which I think is good. And I find some of them very interesting. Okay, so he posted a couple days ago. Gen Z's share of mortgage applications jumped nearly 50% in 3 years. In 2022, they made up just over 10% of mortgage volume. By 2025, that share hit nearly 15%. And again, I think that a lot of people don't think about the Gen Zs as being borrowers yet.
Right.
We kind of think of them as kids, and they're kids who aren't ready to buy a house. Well, that is incorrect. And I mean, I've done a number of loans for kids in their 20s, and they're pretty amazing actually. So he pointed out a 47% gain in market share in 36 months, that's a big, humongous jump. Millennials are still the majority, 51.2% of volume, and Gen X is at 27%. I don't think that number is going to change really. But he said that the issue is when you're qualifying a Gen Z, it looks like they have income instability because they are using RSUs, variable income, 1099 stacked on a W-2, creator income, stock vesting in three different schedules, two roommates, a side LLC. And he's right.
Mm.
Because again, and I've been saying this for years, like we have not really updated our underwriting guidelines in forever, like ever. So this idea that somebody is a W-2 employee and it's easy to look at their pay stub and figure out exactly what their income is, and if it shows us exactly what we've been looking for the last, 4 decades, then we're good. But if not, then they're unstable and they might not qualify. That's where these non-QM programs come in. They're
Yeah.
so important. The only issue is you've got to put down more money, right? Which some of these guys can, some of them are getting family help, but if they have truly funky income, that's an issue. And it's, in my opinion, interesting because people talked about DTI so much, but really the studies have shown DTI doesn't really drive whether or not someone's going to be delinquent on their loan. But also, when I'm doing a loan and I'm pushing DTIs to the limit, I know that they have income somewhere else that they aren't able to use to qualify. So I
Yeah.
know they've got, a roommate or a spouse or a side job that doesn't qualify, et cetera, et cetera. So it would be really helpful if we could get our lenders to catch up with today's environment and give us something, that reflects today's borrower a little better.
Yeah, and then I think it comes down to how you measure that and put guardrails around it. And because a lot of that is, what you think you know about them, and then how do you prove it? How do you put it to paper? How do you create compliance around that so that then it isn't making a judgment call based off of what you know, but we have checks and balances that surround that borrower in the different ways that they do things. So we'll see. Some things are coming, I think, around that a little bit, but not enough.
Not enough and not fast enough. And again, I think there is a security blanket of a W-2 borrower on a salary that a lot of lenders like to have, and that is not our reality anymore at all. And
Mhm.
as a matter of fact, um, when MBS Highway is talking about unemployment numbers, they often point out that a lot of people, when they are laid off, etc., do not go on unemployment. They just start doing gig work.
Mhm.
So, they're driving Uber, or they're, doing some consulting, or they're doing something, and they don't qualify. So it's not a real reflection of what the unemployment numbers should be or would be normally. So again, or like, I mean, if someone in our industry gets laid off, I mean, I don't even, would I qualify? I don't even know. I've never had unemployment. Do I get that? I'm on commission. That's all I get is commission. Do I get unemployment?
Um,
I don't think so. Anyway, yeah, it's tricky, but I think it's something that as an industry we really need to be looking at. And as LOs, especially as the Basel III requirements are being eased. So the banks, which have really stepped away from mortgage lending in the last 15 years, they very well could get back into the game in a big way, and they're going to go after the easy stuff, I would guess. I would think they're going to be mostly, GSE, Fannie Freddie, a paper. And so what that's going to do for LOs like me and our listeners, we really need to be adept at the non-conventional, outside of the box, self-employed borrowers, investors, the the funky income, which is more normal by the day. Those borrowers, those are our people, right? Otherwise, we're competing against, it's going to be like jumbo, where, okay, the banks own it, the big banks own it, and it's hard for us to compete. Well, I mean, conventional might get that way too. So Peter made a comment, being house poor is fluid. Starting off house poor is normal, and always has been, by the way. We've always told our clients, yeah, you're going to feel like you need to eat top ramen for the first 2 months, and you're going to
right.
adjust. It'll feel fine. You're going to be fine. I promise. We are not. Anyway, but as rents and prices go up along with income, the balance shifts as it did for Tracy. And then Joni says companies are paying differently, like per diem, overtime, bonus, and small bases. So that is 100% true. I have a borrower right now where she has a tiny base, the bulk of her, but it's consistent. Thank God, her bonus and commission have been consistent for the last couple of years, but anyway. So that's a whole thing just to be aware of, be looking out for, and becoming more and more of an expert in things not GSE, not conventional vanilla.
Mhm.
Those are loans you can do with pushing buttons more. I mean, more often, or people think you can. What's funny about that to me, we'll see if you think it's funny, Tracy. I don't know. We can vote at the end of this. is is a lot of times somebody will come to me with a an A paper situation, and they're like, I want this. And then when I look at it, I'm like, okay, but what about this? And guess what? They can save a ton more money if they do it the way I've seen it, because I've looked at 10 quadrillion
Right.
different scenarios, and something might pop off the page for one of us, for an LO who knows their stuff, that isn't going to occur to a borrower. So again, I keep saying you can have all the information in the world, but if you don't know what to do with it, it doesn't do you any good. The
Right.
problem is people think they know everything, and they don't value the people who really are the professionals. So we really need to get back to that. Okay, well, I forgot which part of that was supposed to be funny and we were going
I
to vote.
know.
So we'll just move it along.
Okay.
Okay, let's talk about credit. So they have been talking about changing credit for so many years. I mean,
I
literally
know.
like 5 or 6 years ago, we were in DC, and we were listening to Sandra Thompson talk about how they had been looking at, what they were going to do with credit. And I think at that point it had been 5 years. I mean, just an insane amount of years, as they're
Mhm.
like, maybe we should do something. Well, it's happening. So we have all heard, or if you haven't, you have been either in a coma or living under a rock. We have heard that they have rolled out Fico10T and Vantage 4.0. Yes?
Yes.
Yes. Okay.
Well, 10T is kind of coming this summer. You can have it, but in
Right.
terms of, yeah.
Yeah, certain lenders are using it.
Excuse
That
me.
bless you. The GSEs have said they are going to embrace it. So we're going to talk a little bit about what are the differences and how it's looking. And again, we are talking about things that are in the early stages. So it's all subject to change.
Yes.
Yeah.
Yeah.
Okay, so why don't you start, Trace?
Well, I have been doing this forever. I've been on here a few times talking about this, like iterations of what's to come and what we anticipate to come. So, yes, now we finally are seeing some actual movement and discussions about it. There is a pilot program that anywhere between 20 to 25 lenders are involved with now. Some of them are publicly kind of saying that they're doing it. Others have kind of quoted that they were supposed to sign a NDA around it, so they're not being as public about it. So, you know, Vantage and Fico10T have been available to have along with your credit report for a while now. Both are kind of offering a free look at what those scoring models look like. So right now we're using the classic Fico. What is confusing, but we can touch on is FICO 10T is T for trended, and Vantage is also looking at trended data, even though trended data has been a part of the credit report since 2016. So, what's important to know the difference of is that while the GSEs have been utilizing trended data, it has not been incorporated into the score. So now moving forward to the new scoring models, along with some other data that is being applied to those reports, it is including the trended data into the score. So rather than kind of taking a snapshot of where that borrower is in time at that moment, it's looking at the last 24 months of how that borrower behaves. So, are they staying on top of their payments? What their credit limit versus payment? Are they increasing payments? Are they always doing the minimum? That allows to give some more um, kind of flavor to the borrower, looking at what the trends would be. They're saying it can give a better predictability as to whether they're going to default or not. And so Vantage and FICO 10T have different numbers there, but that's what's supposed to be used for. And then the other argument is that these will also be able to reach a different type of borrower. So, if anyone has been lucky enough to watch a panel with Vantage and FICO, they tend to be there's a lot of back and forth in terms of what's there, what's not there, which is better. Obviously, now we're having a competitive market for those scores, and they want to say why theirs works or doesn't work. So, for example, Vantage, uh, you need a month of borrower history in order to generate a score. FICO, you need 6 months data. And FICO would say, well, we believe that you need to look at an accumulation of data in order to find out, what that borrower looks like and their spending habits and all of that. Vantage will come back to that argument and say, well, what if they're a veteran? What if they've been deployed for 12 months, they've come back, and it's an existing account and they just used it again and they're starting up again? Why can't we look at the history and all of this? So there's a lot of push and pull as to whether they think one is better than the other. Another thing to be aware of is that while trended data has existed, scores have existed, the the GSEs don't use an actual credit score. They are not looking at a 680 and saying, "Oh, it's a 680, this is where it goes." It's the investors that look at the score. And when it goes to market, that's how they're purchasing those loans. So, um, there's a lot to think about there as well, where they have been looking at that trended data. They have been approving these borrowers coming through, and it's really the investors that are married to the score. So, Um, it's a exciting but tricky time. And when I kind of have these conversations with people, and I've done a few panels with FICO and Vantage. So for myself, we're a credit reporting agency. We need to resell this data to you, the loan officer. It's important for me to have everything available and make sure that we always have that. But then my other job is to raise the questions that you may have, and that if you haven't started raising them, that you make sure that you are raising. So right now, even with LOS systems, we don't know how this is going to work. So until we're able to look at this, and I should have said this as well, and you cut me off when I'm talking too much, or if it starts going all over the place, which it probably already did. Um, but when we're looking at Vantage and FICO, so it's going to start there. It's going to start with classic FICO and Vantage. It is not apples to apples in their scoring. So if it's a 740 FICO, it is not going to be that for Vantage. The question is, what is it going to be for Vantage? So I was at secondary in New York watching a panel in which they said, it should be about a 20-point spread. I've seen examples of when it's an 80-point spread. And there's not consistency there. And someone from the audience asked if we're going to get a kind of chart that explains where these scores fall and what do we do with it? Because if anyone's seen the Rocket email, they said we're going to use the top and best score. Well, right now, I don't know how that would work because Vantage and FICO have a different scoring model. And then the other is what is better right now? And I think that's the question that many of us need answers to, because what does that look like and how do we get there? Because the other thing is pricing, which is what kind of pushed this forward and is now getting a little bit lost in which score should I use? Because if it comes down to the LO, if one report with a FICO is $5 delta, whichever way you want to go to Advantage, you want to do whatever is best for your borrower. You want to price your borrower the best. And how are you supposed to know which report to pull, when to pull, how you can isolate which score to use, when to use? And then how is your LOS, POS, all of these things being able to um, pull that data? So friends of mine that are with an LOS company that's a larger one, they're waiting right now to decide how to build this because they need the GSEs to tell them. Like, are they going to have a dual score availability? Right now, you can pull in one or the other, but they need to build it so you can see both scores? That hasn't been answered yet, and that's a pretty crucial thing to know in order, how do we price this? How do we move forward? And I saw Natalia said that they're deducting 20 points from Vantage in order to price it accordingly, which is a way I think they have to do it now because they don't know how to price Vantage because there's not enough data.
Okay.
I
So
know.
that
That was
was
word
a
vomit to
lot.
everyone. I
So we're
know.
going to go backwards. First of all, to be clear, UWM is doing a 20-point haircut on
Yeah.
for Vantage just because there has been a conversation about whether the pricing for Vantage is going to be potentially different than for FICO because they don't have the track record for Vantage 4.0 to know how it's going to perform once those loans are in servicing. Are people going to make their payments? Are they really credit worthy? The jury is really out on a lot of this, and that is part of the discussion, which is how do we handle all this? So I want to go back to the trended data thing first,
Yeah.
because trended data, again, to your point, it's been it's been a thing since 2016. It started showing up on our credit reports a couple of years ago. Wasn't that about the time the cost for a credit report really started to go up? And then we didn't really think it was doing anything, this whole time. Well, guess what, kids? It's going to, because for instance, you have a borrower who used to, they come in, they had a maxed out credit account, or God help us, more than one, and you pay it off, and poof, overnight, their credit scores are significantly higher. Well, with trended data, that isn't going to be the case if they're looking back, not if. So both models are going to incorporate trended data, and it's 24, just you, I know you already said this, Tracy, I don't think you can say it enough.
Yeah.
24 months of credit activity rather than a single snapshot. Good God. They're looking at utilization patterns, payment behavior, and account trends over time. So it is really important that you know that we can't do those rapid rescores anymore and think that's going to fix everything, because they're not. So,
Right.
and that is included in the algorithms that are the underwriting algorithms. That's a big deal. Also interesting, I thought, to note that Fico10T builds a model for each bureau. The word
Yeah.
that was used was bespoke, which I hate that word. Anyway,
Mhm.
but they build a model for each bureau, maximizing their unique data. Vantage Score 4.0 uses one algorithm across all three bureaus to keep the scores consistent. And so
Mhm.
that's the difference too. And they have both sides have done studies, right?
Yeah.
So of course they all have, again, back to this idea of data, they all have data. Whether or not you believe said data is, the next question. So and that is a big raging debate on LinkedIn, is which data is correct, which score is more predictive of borrower behavior and their ability to make a mortgage payment. And at the moment, FICO is winning that conversation just because there is a history with FICO where there really isn't with Vantage. So the conversation has also been that there will be a pricing hit for Vantage just going forward. And I think that probably will stand until there is enough of a history where they can look at the performance of these loans once they are funded, and
Right.
whether the borrowers are actually paying. And then once they have some comfort, and it's going to take a while.
Yeah.
FICO's been around for a very long time, and this is new.
Yeah.
You know how we love new.
Right. Well, it goes from, and kind of that's why I was talking about it. It originally went to, yeah, we need competition in the market. Well, it's not the same product that they're offering. So that makes it tricky, right? So then
Right.
when we're moving forward with it, how does Vantage get the edge? Obviously, that's where they're talking about the product and it's going to hit more borrowers. FICO has a very different response to that.
Yep.
And so until there is some measures to be able to compare and contrast them in actuality. And there is some security in knowing what you're going to get and that's, how it's going to benefit you, how it's going to benefit the borrower. There probably will be hesitancy. And I
Right.
haven't seen anything yet. I mean, for the UWM, um, you know, what does it look like for a LO? What is attractive to you about Vantage as we move forward over FICO? Is it because you think you'll be able to attract more borrowers, be able to get more loans? And is that happening in actuality? Because just because they have a score doesn't mean that they're eligible for a loan. And do you know what that looks like? Like, what does it mean to be eligible for a loan within that scoring model? So, there's a lot to learn that we need to factor in before it can just be, oh, now we have Vantage. And that's, for us, a frustrating point of we keep coming back to the same thing, announcement over announcement over announcement, where it's like, I get it, but we got to hold. We got to wait for the data. We have to let people manage this a little bit so we start to see. And also, we need more direction. We need more answers from the GSEs as to what we need moving forward in order to price them. How is this going to factor for fair lending? Are
Yeah.
we, what does lender's choice look like? How do you offer that? How long does that last? If we're thinking about pricing right now, you can get FICO 10T and Vantage for free, basically, to do a side by side. But down the road, what does that look like? Because that's not going to be free forever. And then how are you supposed to pick and manage your LOs where we can't even get people to pull a two bureau report because they're wondering what the third bureau is? What is that going to look like? Well, I don't know what their Vantage score looks like versus FICO. So now at some point, are we going to be pulling six scores for a single borrower, and then you have to pick which one you do, and how does that work? And what if you're a shop that only offers one or the other? There's a lot of concerns out there regarding fair lending and how that will pan out, and there's been very little talk about it.
So that has been an issue and a conversation for a long time as far as cherry picking which scores the best. So I've heard two sides of this. First of all, when a borrower comes to us with crap credit, we coach them on, okay, if you do X, Y, and Z, this should improve your credit because we're trying to help them. That's, I mean,
Mhm.
and some people don't know, and where else are they going to get the information? Yeah, yeah, yeah. I have heard people talk about that not being it not being okay to, like if they come to you and they say, hey, I've looked up all my scores and this one's the highest one, and then you go with that and somehow you're steering and now you're going to distort the credit picture because that score's higher but then the other one's lower, and maybe that's more predictive of what will happen in the future with their mortgage payment. Do you see? I mean, it's
Yeah, I think,
complicated. And then what,
yeah.
so I, to your point, I want direction too. I want the GSEs to clearly state what is it that they think is acceptable so we can figure out how to work within that.
Well, I think you hit on this earlier too, which will be interesting is, the score navigator, credit expert, all of those. Right now, we're not familiar with the solution that's ready for some of this, but there's a difference between educating your borrower
Yes.
of how to utilize credit, what's the best way, what's going to get them the best score versus a quick fix, right? Where
Yes.
I just need my borrower to get over this, they can pay down this credit card, it'll bump them up. So to see how, if they are riding that limit for the last 12 months and have the same balance, or it's, versus consistently paying down that balance, that will weigh that borrower differently. So how it helps in terms of long-term improving of scores, I think that's a very different impact that we'll see as well of like what does it look like to build that up? Is it still keeping it at 20% of the credit limit? Is it consistently paying it off? All of those we need to be able to see.
Well, I also think that a lot of lenders and borrowers think that if they have a certain score, they're going to get an accept. And that is no longer the case. A credit score is just one factor in the
Right.
overall risk assessment that's being done by these algorithms at both bureaus. And it's really important to understand that. So, okay, so until recently, this is something that I wrote that I read. Until recently, so Fannie Mae required, remember, a 620 credit score.
Yeah.
Freddie required a 620 to 660, depending on the scenario. Now, both GSEs a few months ago eliminated their credit score requirement.
Yeah.
So that if you're going through automated underwriting, that is. So it's supposed to be designed to help the borrower that doesn't have a really robust credit profile. So maybe they don't have as many accounts, et cetera, or as much time. But in general, they're saying that most approval loans probably will be over 620, but it definitely does not, it's not a minimum credit score requirement. So that was interesting. Okay, so let's talk about the pricing again. So again, the GSEs are not using credit scores per se to qualify borrowers and decide whether they're going to approve you or not. That is not what Fannie and Freddie are looking for. It's an overall credit profile that they're looking at
Mhm.
And that that is one thing. The pricing is done by the lenders. And there are LLPAs that are put in place by the GSEs for sure, but the credit scoring is really being used to price a loan. And there is a huge disparity between a 700 score and a 620 score. So you're talking about an interest rate. This is as of February of, you had a 700 credit score, you were at 6.61% on a rate. And if you had a 620, you're at 7.17%. That's a big
Wow.
difference. Yeah, big difference. So and also the other thing too is, do you remember after the meltdown, um, and it got to
Which
it,
one?
great point. The original meltdown after in 2008. Do you remember how the joke was 720 is the new subprime score because
Okay.
the credit box just got so, oh my God, it was so, everything, the guidelines just tightened up, tightened up, tightened up. And so anyway, it is if you want to avoid an LLPA, you have to be over 780 at this point. Not, and it used to be more
Wow.
like 740 to 779. So I just, yeah, don't I mean, anyone who has listened to this show for more than 3 seconds knows that I think the LLPAs are egregious, way more than they need to be. And the fact that they're cumulative, so you can trigger like four of them and they just get whacked onto each other, so you can have a 2% difference. So anyway, yeah. So, and then back to the 20-point thing, that is something that lenders are doing just because they don't know what else to do. They do know that there could very well be a pricing difference for a Vantage score, and so they are taking that into consideration. And then again, depending on which study you're looking at, and who you believe, then you know, Vantage may be a little more, there's a feeling that Vantage is a little more loosey goosey and is not going to be um what's the word I'm looking for here? Uh
It's conservative.
I was going to say stringent, so yeah, probably right in there. So there you go. So I'm curious to see as this all rolls out, like how are we expected to advise our clients? What is okay as far as um figuring out how to help someone qualify. And so there you go.
Well, I think so. Natalia put something out there. It looks like Vantage is always higher than FICO. In what scenarios regular FICO will be better than Vantage? And I think that's a really important question because just because Vantage is higher does not mean that it is better. Once again, it's not an apples
Right.
to apples. So it's not if Vantage came back at a 700 and
Yep.
FICO was at a 680. It doesn't mean that Vantage is better. It means that is their score model for that borrower. So that could be right on par with each other. I mean, and technically, in some cases, more likely than not, it should be. It should be kind of matching up. Now, there are different ways that they're measuring. I believe medical collections will be measured differently. It depends on utilities or rental, but again, that's something that's being put out there a lot, and it is a minuscule percentage in terms of what's actually coming onto the credit report. So, um, until we get a look at what does one look like in the world of FICO and what does it look like in Vantage of the same borrower, until we have that answer, it's almost impossible to say what's better. And like what, to your point, Audrey, it's like who's defining that? What is advantageous of one or the other? If we're talking about a market that wasn't getting a score, and because it's looking at that borrower differently, both have that trended data, both have that data that should help score the borrower differently. Vantage could hit slightly different because they're not taking collections into consideration. They what was the other one for them? Oh, the newer trade lines are being scored. But then again, is that still a scoreable borrower. They might get a score, but is that hitting a threshold that you need or an investor needs to be able to lend them money? So those are questions I think we need to have answered more versus, and I told someone with Vantage where I always like listening to him speak, but I'm like, you guys are getting so caught into the which one is better rather than what does it mean to us as a lender community of how we interpret it. What are the interpretations? What are the guardrails? Where's the fair lending conversations? I think we as an industry need to push that more rather than, well, which one's better? In order to diagnose it, you have to understand it, and we're not there.
So we've talked about this for a couple of years, actually, probably starting with you, because the idea that you're going to have utilities and rent, et cetera, on a credit report, that's fine and dandy as long as someone's paying those things on time. And we certainly have seen people who have an 800 credit score, but they hate their, internet company and they pay
Yeah,
the last second because they don't want to, because it's kind of their to you. And
yeah,
and so again, part of our messaging needs to be we may have utilities and rents, etc. Right now it's voluntary, but we may have those things reported going forward, and you need to make sure that you're paying those on time as well.
yeah. That's me. I'm the problem. I was that person. I was like, oh, yeah, I'll remember that. Like, it just wasn't top of mind like everything else was.
Have you reformed?
I have.
Is it based on this?
I mean, it did help me push me in the right direction also. Yeah. But it was kind of like get your stuff together, woman. But
Well, it's you're not the only one though. I mean, this is something that we've seen, and again, when there is this idea that, well, they're not reporting, so who cares? It is a different attitude.
it is. You're more lackadaisical.
Well, and again, going back to the Vantage score and them giving you giving you some sort of score at 1 month, we all know that I mean, anyone can open an account and keep it current for a month,
Right.
but can you keep it current for 5 years or 20 years? But then that's my other big gripe where you've got somebody who's got an account for 50 years, which I've had this happen, and they use their gas card for the first time since they moved, forgot that there was no updated address, didn't get a bill, and now they have a late on a 50-year-old account, one, and their score drops 100 points. Does that reflect how responsible they are? No.
Right.
It's you know what I mean? Like that's what I have never liked about this scoring system is that it doesn't take into account the one-offs that happen, because before scores we could at least look at something and go, oh well, it was just a one-time thing, it was more subjective. And now it's this, well, there's 100 points, it's
Right. Yeah.
why, oh, you 2 days ago you qualified and now you don't. It's just ugh, ugh. Okay.
Yeah.
So there is, as of May 20th, there was an announcement about something called FICO Ultra. I
Hmm.
just want to be clear, this has not been adapted by the GSEs yet. It is something that I've seen other lenders use, though. They're partnering with Plaid. I mean, I don't know if you're familiar with Plaid, but I've seen it pop up in a few different things where I've had to opt, like, I'm trying to
Yeah.
remember what they were, but anyway, where you have to say yes, and then they look at your bank accounts, right? So it's a credit score that combines the FICO score with real-time consumer permissioned cash flow data. It's delivered in the same industry standard score scale lenders already use. Um, and so basically, they're looking at your bank accounts. They're looking for account balance stability, spending behavior, and then that's added into your credit score. So I just think this is really interesting because this very well could be the direction we're headed. And how many times have we had borrowers say, oh, yeah, I have a 680 score, but I have a ton of money in the bank. What's the big deal? And that money never, it doesn't translate to you being a better risk for a lender as far as a score goes.
Yeah.
So, yeah, what have you heard much on that?
I have, and it existed in a different iteration before, and it was linked up with Finicity, but
Oh,
it was kind of like a quiet. Finicity similar to Plaid, but it was they're linked to Mastercard. They did it a limited rollout. Now it's we'll see where this goes. I will say in conversations that I've had in roundtables. I personally like this. It's a different way to go very back to the start of the conversation. Different types of borrowers, different types of spending, buy now, pay later, different jobs. This gives you access to look at their bank statements. It's showing you what they do. Some people don't want to have a credit card. I mean, we talk about the mentality that we had of like, where you're from or how you grew up is how people are like handle your money a specific way. And they don't want to have that debt. They don't want to have the 30% APR, whatever it is. And so they pay things with cash or they pay it off right away or every month. That doesn't reflect well on a credit report and the credit scores. We've seen it time and time again where someone be like, well, how do they not have a score? They just pay off their credit card every month. And the fact that that can make you look bad, and then you have to play with the system to get a score, that's tricky. And it's counterintuitive oftentimes when I'm talking to people about how to improve their score. It is counterintuitive. Keep a balance. Don't have it at zero. Pay it off, but keep it down here. You're generating activity, but they could do better. I don't want to have a $20 balance because I might forget to pay it because it's so minimal and get a
right.
late, and then it makes them look bad. Or you have a renter who's been paying rent for, the last 3 years at a really high rent. They live in an area where there's not homes to buy. I like this because it really does capture what would be considered a thin file borrower in ways that you can't do in a credit report. It would take into consideration all the bills that they're paying, how they're paying it, how to look at it in a way that you're not dependent on all these other places kind of coming to you and giving data. So I see the future of credit and credit worthiness headed in this direction because I've also heard the desire of that from the LOs of like, perfect world, I would have this data from different data points. It's not just coming from the bureaus. We're able to look at this. Now, adoption is a whole other story because it would involve borrowers. So they have to give access to this. They'd have to sign off on it and think about it similar to a VOA. If you're doing a verification of asset, it's the same thing. That's how, Plaid and Finicity, they were utilizing this. And a lot of people have a hard time getting it off the ground because there's a fear of the borrower doesn't want to give their bank account information. And I was in DC for advocacy last month, and the biggest thing the GSEs were talking about, it'd be great if people adopted more of direct to bank communication and that would help bring down the costs in several ways, but we just can't get there as an industry. The borrower is not ready, quote unquote, to access that. So my next point is then make it easier to access. Don't make it seem so daunting of, yeah, here's my Chase checking like login. How about we have an authorization or do something similar to credit? So,
Well, I think in some of those instances, I mean, I know there are some big banks where they go through your bank account information and they hit your DTI with your pet insurance, and all of a sudden you don't
oh,
qualify. And so there are a lot of reasons and that people don't want to
yeah,
let
that makes sense.
somebody have access to their bank information. I mean, some people don't like the fact that everything is so out there. They want some
Mhm.
privacy. And so this idea, oh, it's easier for you or me or whatever is just part of the equation. And so it's yeah, it's and Jenny had asked if you use a credit card regularly, but they pay it off in full every month, that hurts your score. And again, I think you can answer that, Tracy.
It can, because again, remember it's a snapshot. So depending on when you put the balance on it and when you pay it off, If it's showing a zero balance, zero, it's not showing activity. So now moving forward with the trended data, it will look at that, but on the classic FICO, it wasn't before. So if it was at a zero every month, hurt your score. I don't know if it hurts it, but it doesn't help improve it. So you could potentially get a higher score with a small balance rather than a zero balance.
Well, the flip side of that, though, Tracy, is that when you run the credit, and if it happens to be somewhere in the cycle where
Oh,
they're
right.
maxed out on that thing, but they pay it off every month, and then it makes it look like your score is crap because
Right.
for some, ridiculous reason. So yeah, it is complicated. It's
But that's where it should improve, right? You shouldn't have something that, depending on the time of day or the week, you could get a spread of 20 points. And you shouldn't be able to manipulate it or find a quick fix as easily. It should be like, here is the trend of this borrower. This is what they look like. This is how they handle their money. And it should have a better idea of what this borrower looks like and what their trends are.
In my opinion, it would be much better if the algorithms were more transparent as far as what goes into them, et cetera. And
Yeah,
why it needs to be a secret is beyond me. The
because
whole
competition.
the whole lot, okay, competition. That is such crap. Anyway, I know I get it on the one hand, but you're talking about borrowers' lives. And
Yeah,
so why shouldn't, again, back to the credit bureaus, it's a pretty sweet system where they charge people to report the data to them. And then they take your data as a consumer. And then when you need access to it, you have to buy it.
right.
Like,
Right.
I mean, how is it not free to the borrower? That's their information that it's just mind-boggling, but I try not to go there too much because I know there's nothing I can do.
We can spiral.
It's all fine. So anyway, it is yeah, so Jenny said by the time it's paid, it already has a balance, never has a zero balance. But not everyone's like that. So it's everybody manages their credit differently. And again, there's a real disconnect across the line as far as what people think or think they know, etc.
Mhm.
And and then how that translates. And that's where we've come in for so many years, which is we help them figure it out. And so we need to understand it. And when things are changing, then we need to understand it again. And how do we, and it's not steering, it's not trying to manipulate the system, it's trying to help people be better financially and be better stewards of their credit with, because otherwise, how will they know?
Yeah. Keep asking questions. I think that's the main thing. And keep pushing the company that you're working with or whatever organization to say, what are you hearing? Making sure you're staying informed and not get lost in kind of this. There are bigger questions to ask that we need to figure out before we can confidently move forward. And I think, we need to get there together.
Just something else to think about this week.
Yeah.
We've mentioned it a few times, but the Pope issued a gosh darn it, I meant to write it down. Anyway, they actually did a oh my God. Anyway, he issued not a statement, although I guess in part it was a statement about AI. And it was from a moral and it was all encompassing. And they did this also during the Industrial Revolution about, hey, think about this, think about that, think about this. So just it'll be interesting to see how people digest those thoughts. And I'm genetically Catholic, but I'm not a practicing Catholic, so it's not like I hang on to every word that the Pope ever speaks at all. But I just thought it was really interesting to hear what they said. And
Yeah.
then always as an LO, remember, as far as the AI conversation goes, who's accountable if it goes wrong? And the answer is you, me,
Yeah.
not you, Tracy, just us. Uh,
No, me
the,
too.
L- the LOs are held responsible. The lenders are held responsible. So don't give it all up to an artificial intelligence yet. And again, we are in the green this week, right now, in this moment. But Thursday is a big day as far as economic information this week. So make sure you're not, taking your foot off of the, well, not gas necessarily, but, pay attention and make sure your loans are locked if they are going to close shortly. Any other last thoughts, Tracy?
I just appreciate time with you. Sorry it was all over the place, but once again, one day I'll be able to come on and give definitive answers for everything. But until then, it's always great talking to you and your listeners and trying to share as much as I can about this fun world of credit.
Tracy, we live in the industry of it depends. I don't
Yeah,
see that changing anytime soon. So we just try to navigate it. We ask a ton of questions and we're always curious and wondering, okay, now what? So thank you
yeah.
so much for your insight. We love
Thank
you.
you.
I love you. It's so good to
Love
see
you.
you.
Good to see
All
you.
right. Have a great week, everyone. There are loans to do. They might not be easy, but if they're not easy, that means there's less competition. So, mwah, have a great week, guys.